Welcome back to Around the Table with Stacy Smith. We're talking about the economy and investing. And speaking of the economy and investing, we are now coming to the end of the second quarter earnings season reporting period, if I can call it that. I guess it's the season. So, Kim, how would you rate this season so far? Good, bad, indifferent, a mixed bag?
It's a mixed bag, but I think what we really have to concentrate on is most companies have reported earnings and revenue greater than what they anticipated. Now, having been a sell side analyst, which means I didn't actually buy and sell stocks. I wrote about what people should do, and it was my job to make models and be able to forecast what the companies that I followed, what they were going to do in the quarter. Companies can't terribly, they have to tell the truth. They have to tell the best version of themselves. They can't tell make it too rosy, but they also can't be overly pessimistic to give them super easy things to step over. But I think because of last year's decline in all markets, bond and stock, and then the uncertainty of recession worldwide, but especially here in America, I think companies really set the bar low and they stepped over it. Some of them tripped, but most of them stepped over that bar. But more importantly, what they've been doing is guiding revenues higher, but this is not what anybody that does what anybody on this program would have expected. They are saying that earnings are going to be higher too. It's a crazy time. I think that this is because of a couple of things. The economy is stronger than we think a little bit. We are not going into recession, and I've been a proponent saying that we wouldn't go into recession. But finally, I think a lot of the comparisons year over year, we are really through the supply chain issue. I would say even through the fourth quarter, companies were still having to pay too much for necessary items for production or even just keeping the company running. And I think we are completely through with any supply chain disruptions. So those things, and just a little bit of wind at our back. And oh, by the way, the Fed's either done or very, very close to done raising. I think that has set us up for companies being able to forecast comfortably higher earnings and higher revenue that drives those earnings. So maybe I'm talking myself into giving it a B plus as opposed to my original B minus. But so that's the way I see things.
When you look at some of these comparisons, you see that they're saying earnings are down from a year ago, and that's true. However, they're up from this first quarter, which were up slightly from the fourth quarter. And what I see is earnings turning. I think they bottomed out in the first quarter. They're higher in the second quarter than they were in the first. When the third quarter reports start coming out in October, I expect that we'll see them in the second quarter. And if Standard & Poor's guess is good, and I do mean guess, in the fourth quarter, they'll be as high as they were before the pandemic, which is as high as they've ever been. And if that's the case, the market is not as high as it's ever been, but it's getting close. And I think that the ship is turning slowly, and it might get bogged down. It might get into some doldrum here and there because things aren't perfect, far from perfect. But I think that the worst is over and we're on our way. And the next recession will be when something else causes that to happen, not what's been happening. Because as Kim said, interest rates are probably pretty much done going up, and they're not high. These interest rates for good business decisions are not prohibitive at all.
Well, one thing we have to keep in mind is that earnings and stock market returns are two separate things. Earnings is a report of what's happened in the past, and stock market returns are a prediction of what the market anticipates going forward. So let's not forget the market was down pretty significantly last year. So to see right now, I think we're on pace for about a decline of like 5% decline collectively with S&P earnings during this quarter. And well, the market was down last year, so maybe the market got that right. But as we look to the future, the things, and we could prognosticate all day, but I think the important thing is, what are we watching? You know, our interest rates towards the end. I think a lot of that has to do with what we talked about a few weeks ago, which was wage inflation. Are we still seeing that? Do we really think that interest rates are done going up? Over the weekend, we had a Fed governor comment that maybe they're not done going up. And that's something Michael has talked about repetitively, the implications of interest rate increases and the impact that that may have on consumer spending and on earnings. So I definitely feel that the economy is strong, basically based on the jobs numbers. And as long as employment remains strong, I think that my view on this won't change, but you have to continuously watch the data.
And Carrie's right. I've talked about interest rates till I've been blue in the face before, so I won't bore you with that right now. But I think Kim really hit the nail on the head in a number of ways. I actually have an earnings dashboard that I follow. It looked pretty good in the second quarter. I mean, 80% of the companies beat earnings estimates, and about 60% did so on the top line from a sales standpoint. But I think Kim's right. Investors and analysts are probably pessimistic at the beginning of the year and last year, and so estimates were a little bit low, and companies were able to beat them easily. I do worry that now investors are becoming a little bit more complacent, overly optimistic in what we and can expect in the back half of 2023 and into 2024. So, not saying that we're due for a big pullback at all, but it's certainly not going to be as easy, I think, going forward to beat analyst expectations or to hit those numbers maybe as it was in Q2 of this year.
All right, very quickly, Mike, I'm going to throw this back at you. A couple of one of our recordings a couple of weeks ago, you indicated that one of your hesitations about being euphoric about the way the markets were going were, especially with the NASDAQ, that if just a few of the stocks were really pushing that thing higher.
Right.
Is that still the case? I mean, are when we take a look at these earnings reports, do they jive with the way the market did go up?
It looks better. I mean, the market has broadened out over the past 5 or 6 weeks or so. But again, that's a pretty short time. I mean, that's good news, right? For sure. If you look at it, Stacy, from January 1st through the end of the second quarter, June 30th, you had what is being dubbed the Magnificent Seven: Apple, Facebook, Amazon, Tesla, NVIDIA, Google, Microsoft. Those 7 stocks really drove the markets. And the other 493 or so were just kind of muddling along. But over the past 6 weeks or so, and Kim can probably talk about this better than I, but over the last 6 weeks or so, you're starting to see it broaden out a little bit more, which is certainly a lot healthier for the markets. But make no mistake about it, those 7 stocks have really driven the outperformance of the market so far in 2023.
All right, great. Thank you. We have to take a break. We'll be back in just a moment.